All right, let's talk. For all of you in the trenches, the traders who live and breathe these markets, welcome. We're not just here to guess what's around the corner for December 2025. We're here to really understand the lessons the market has hammered into us over the years and to gear up for the very real risks that are waiting for us.
You know, this quote really hits home for me, because trading was never just about staring at charts and numbers, was it? It's a conversation. It's a dance between you and the market. And the market can be your best partner or it can be your worst enemy, but it always knows how to test you. And December, well, that's when the final exam happens.
So here's what we're going to cover. First, we'll set the stage for this year-end arena. Then, we'll break down the 5 critical risks, the big, explosive ones, and the sneaky ones that hide in the shadows. And then, most importantly, we're going to flip the script and talk about how to turn all of that danger into a real, tangible advantage.
Let's get one thing straight. December 2025 isn't just another month on the calendar. It's the grand finale to a pretty wild year. I mean, think about it. We've navigated aggressive central banks, geopolitical chess moves, and the explosion of AI. This final month is where it all comes to a head. And it happens just as the big institutions are thinning out, just as liquidity dries up, and just as retail traders are most susceptible to the price traps they never see coming.
This brings us straight to risk number 1. And this one doesn't knock politely, it kicks the door down. I am talking about volatility. Raw, unpredictable, and completely unforgiving volatility. And believe me, we have seen this beast unleashed many times before. Let me tell you a little story.
I will never forget December of 2018. The U.S. market had one of the ugliest year-end drops in its history. They actually called it the Christmas Eve massacre, and for good reason. The S&P 500 just fell off a cliff. Forex pairs were swinging so violently it was nauseating. I had experienced traders telling me, I'm not looking at a chart anymore, I'm looking at a monster. The psychological shockwave was huge. So many new traders just quit. They packed it in and never came back.
So why am I digging up this old ghost? Because the market has a long memory. And December has this nasty habit of repeating its old tricks. If it decides to get volatile, it does it at a level that gives you absolutely no time to react. So the real question we need to ask is, why? Why does this happen? And what makes us so sure the conditions are perfect for it to happen all over again?
So, what's the recipe for this perfect storm? It's really a collision of 3 massive forces. First, and this is the big one, liquidity just vanishes. The big players, the hedge funds, the banks, they're winding down. Their star traders are on vacation. This makes the market thin. Think of it like a shallow creek instead of a deep river. The smallest stone can create a massive splash. Second, the policy calendar is loaded. The Fed, the ECB, the Bank of Japan, they all have their final, critical meetings. One word changes in a statement, and you can see currency markets go haywire for days. And third, well, it's emotion. It's pure, raw human emotion. You've got profit-taking, funds window-dressing their portfolios to look good, and you have novice traders desperately trying to make back their losses. You mix that emotional cocktail with thin liquidity, and what do you get? An explosion.
And if you want to see this volatility on steroids, just look at the crypto space. Remember December 2017, Bitcoin went absolutely parabolic. $10,000, $15,000, all the way to nearly $20,000. The retail crowd was giddy. Everyone was a genius. But do you remember what happened next? The dream turned into an absolute nightmare, a crash straight down to $6,000. I'm telling you this because December 2025 will put the crypto market in a major redistribution phase after the last halving. Any trader who disrespects volatility in that environment is going to get swallowed whole, period.
So here is the fundamental truth, and I want you to burn this into your brain. Volatility itself isn't the real killer. It's just the overture. It's the catalyst that takes every other little mistake you make and magnifies it into a catastrophe. Traders don't die from volatility. They die from being unprepared for it.
Okay, so we've talked about the storm raging on the surface. But what about the sharks that are circling just underneath? Because volatility is just the trigger for the more subtle, more insidious dangers. Let's look at the hidden traps that are waiting for the unprepared.
And that brings us to risk number 2, abnormal, almost bizarre reactions to economic data. In December, even a boring data release can pack a knockout punch. Let me give you the perfect example. The CPI shock in December 2021. The inflation number came in just 0.1% higher than expected. I mean, that's barely a rounding error. In any normal month, the market would have barely blinked. But in the thin liquidity of December, it was like dropping a boulder into a pond. Gold dropped over $20 in an instant. The dollar surged. Stocks fell for 3 days straight. The problem wasn't the data. It was the year-end psychology and low liquidity creating a punishing, illogical overreaction.
Now for a risk that feels personal to every single trader out there: stop-loss hunting. We've all felt it, right? That sick feeling in your stomach when the market just sweeps down, takes out your stop by a few pips, and then immediately V-shapes right back in the direction you predicted. In December, my friends, this is not an accident. It's a feature of the market. The thin liquidity makes it a paradise for this kind of predatory behavior. It's just cheaper and easier for a big player to shove the price to a level where they know thousands of retail stops are waiting to be triggered.
And this is the brutal anatomy of how it works. It's a simple 5-step playbook designed to shake you out of your position. The market's fragile. Big money initiates a sharp, fast move. Boom, they hit a cluster of stops. That cascade gives them all the liquidity they need to fill their orders. Then they aggressively reverse the price and continue on their merry way, leaving everyone else behind. The flash crash in early 2019 was this exact thing on a massive scale. But here's the thing. The warning sign started flashing back in December 2018. The market always whispers before it screams. The only question is whether you're listening.
We've covered the external threats, the market's behavior, its traps, but now we have to turn inward. Because the most dangerous risks you'll face in December aren't on the chart. The real battle is almost always with yourself.
This is risk number 4, and it's about understanding that you're playing in the game of giants. Let me be blunt. While you're analyzing a 5-minute chart, the big funds are making moves that have absolutely nothing to do with your technicals. They are window dressing, selling off their losers and buying more of their winners to make their year-end reports look fantastic for their investors. They're rebalancing massive portfolios, which can create a sustained, unnatural wave of buying or selling that will steamroll right over any support or resistance level you've drawn. You can't fight them. You can only respect their power and stay out of their way.
And now we come to the final risk, the most dangerous of them all, because this one comes from inside you. Year-end FOMO. It's that little voice in your head that whispers, "I need to make back my losses," or "I just need one big win to end the year right." This feeling pushes smart traders to abandon their plans, to over-leverage, to chase pumps. It's the silent account killer. The truth is, December is when the most accounts get blown up, and 90% of the time, it's not because of bad analysis, it's because of bad emotions.
Let me tell you one last story that has always stuck with me. I knew a trader, 10 years of experience, disciplined, profitable, a true professional. But one December, he got in his head, "I'm going to end the year with a massive win." He got in at the top, he held all the way to the bottom, he revenge traded, and in just 3 days, he torched almost his entire year's profit. When I asked him what happened, he said 5 words I will never forget. "I lost to myself. No one is immune."
Okay, we've outlined the battlefield, we've identified all the enemies, both outside and inside. But a masterclass doesn't just end with warnings, it has to give you a new way of seeing things. So now, we pivot. Let's talk about how to transform these very risks into a powerful advantage. This is what separates the professionals who thrive in December from the amateurs who are just trying to survive.
The difference in mindset is night and day, and it's all right here. When volatility hits, the novice thinks it's a lottery ticket and jacks up their leverage. The professional sees danger and immediately reduces leverage to protect their capital. When the market moves illogically, the novice tries to force their analysis onto chaos. The professional? They just stand aside and wait for clarity because they know not trading is a profitable decision. The novice places their stop where everyone else does. The professional anticipates where that liquidity pool is and plans their entry after the stop hunt. The novice fights the giants, the professional gets out of their way. And finally, the novice gives in to FOMO, while the professional sticks to their plan with iron discipline.
So what is the professional's approach in practice? It's simple. They trade less, but with much higher quality. They aren't trying to scalp every 10-pip move. They are waiting patiently for that single premium moment. And what does that look like? Well, it might be that clear, aggressive reversal after a stop hunt is over, or it might be a calm entry on the second day after a big central bank announcement, once all the chaos has died down. They observe the market's reaction instead of trying to predict it. And above all else, their number one goal in December isn't to make a fortune, it's to survive, to protect their capital and their psychological well-being, so they can come back and trade with a clear head in January.
So you have to learn to fear the right things. Strong volatility itself isn't scary. Trading it without a plan and with way too much size is. Stop hunts aren't scary. Placing your stop in the most obvious crowded place is. The game of giants isn't scary. Trying to fight a multi-billion-dollar fund with your small account is. You see the pattern here? The fear should not be of the market, but of your own lack of preparation.
And that's what this all boils down to. December 2025 will be a major test, but it is not a test of your technical analysis or how much you know about the market. Anyone can draw lines on a chart. This is a test of your psychology. It is a test of your discipline when your emotions are screaming at you to do the wrong thing. It is the ultimate test of your maturity as a trader.
If you can approach this month with awareness, with humility, and with a strategy that is rooted in defense, then December is no longer a storm to be feared. It becomes an opportunity to prove to yourself that you are different from the crowd. An opportunity to finish the year not with a lucky win, but with demonstrated skill and discipline. This is your chance to step into 2026 not just with your capital intact, but with the confidence and posture of a true professional.
The market does not choose who to favor, but it always eventually rewards those with discipline. I wish you a sharp mind, a steady heart, and a sound strategy as you step into this final challenging month. Trade safe, and most importantly, I wish you to survive long enough to become great.